Have you ever wondered how people can make money even while they sleep? Picture this. You're lying in bed, your phone in hand, and with a few taps, you've just made a profitable trade. That is the world of Forex trading, where over $5 trillion is traded every single day, and it's accessible to anyone with an internet connection. But how does it work? And more importantly, how can you get started? In this video, I'll guide you through every step of the way. We'll break down the basics of Forex trading, making it easy to understand even if you're a complete beginner. We'll demystify currency pairs, explain how to read charts, and share powerful strategies that successful traders use daily. You don't need to be a financial expert or have a lot of money to start. Forex trading can fit into your daily life. It's all about knowing the right steps and having the right tools. So if you're ready to take control of your financial future and explore the exciting world of Forex, stay with me and let's dive in. What is Forex trading? Forex, short for foreign exchange, involves exchanging one country's currency for another's. Whether it's for tourism, global commerce, or personal investment, Forex is integral to these transactions. But what sets the Forex market apart? It's the most immense financial market globally, with a daily trading volume exceeding $5 trillion. This volume not only dwarfs the combined trading volumes of the world's stock markets, but also ensures high liquidity. This means you can buy or sell large amounts of currency instantly without significantly affecting the market price. Forex trading isn't just about exchanging money for a holiday or business trip. It's about speculating on currency price changes in the global market. When you trade in Forex, you work with currency pairs. This means if you buy one currency, you're simultaneously selling another. It's like swapping euros for dollars or vice versa, hoping to profit from changes in their exchange rate. The Forex market's vast array of participants includes major banks, financial institutions, and individual traders like me, all influencing currency prices based on supply and demand. One key aspect of Forex is that it doesn't operate through a centralized exchange like stocks or commodities markets. Instead, all transactions occur directly between traders anywhere in the world on an over-the-counter OTC basis. This structure allows the market to operate round the clock, accommodating different time zones and enabling traders to react immediately to global economic events, political changes, and other influential factors. This continuous dynamic trading environment makes Forex uniquely flexible and accessible. Understanding currency pairs. In Forex trading, every exchange involves two distinct currencies. This interaction forms what's known as a currency pair, which reflects the exchange rate between two currencies. This pairing represents the exchange rate between two currencies and is the fundamental component of Forex trading. To better grasp how these pairs work, let's delve deeper into their structure and implications. Structure of currency pairs. Base currency, this is the first currency listed in the pair. It is the currency you are buying or selling. For instance, in the EUR-USD pair, EUR is the base currency. Quote, currency, this is the second currency in the pair and represents how much of the quote currency is needed to exchange for 1 unit of the base currency. In EUR-USD, USD is the quote currency. So how can you read currency pairs? For example, a quoted price of EUR-USD equals 1.20 means that 1 euro can be exchanged for 1.20 US dollars. If the price increases, it indicates that the euro is strengthening against the dollar. Conversely, if the price decreases, the euro is weakening relative to the dollar. Now, it's important also to know that there are different categories of currency pairs. For example, major pairs. These are the most traded pairs, each including the USD and one other major currency like the euro, Japanese yen, or British pound. They are characterized by high liquidity, tight spreads, and often lower trading costs. Minor pairs or crosses. These do not include the USD but feature other major currencies. While less liquid than major pairs, they often provide valuable opportunities for diversification. And exotic pairs. These involve a major currency and a currency from a smaller or emerging economy. For example, USD's TRY, US dollar / Turkish lira. Exotic pairs are less liquid, more volatile, and have wider spreads, making them riskier but potentially more profitable. And there are also different factors influencing currency pairs. These can be economic indicators like interest rates, inflation, and employment data that significantly affect currency values. For example, A country with a high interest rate provided by its central bank will generally see a stronger currency due to higher returns on investments priced in that currency. Also, currencies from politically stable and economically robust countries tend to be stronger and more stable. And of course, the market sentiment and traders' perceptions and future expectations can drive currency movements as much as actual economic data. Lastly, geopolitical events can also affect events like Brexit, causing significant volatility and unique opportunities in currency pairs involving the British pound. Now, traders must choose pairs that suit their trading style and risk tolerance. For instance, those looking for less volatility may prefer trading major pairs, while those seeking higher profits and accepting higher risks might opt for exotic pairs. It's essential to stay informed about global economic events, utilize both fundamental and technical analysis, and keep abreast of news that could affect currency strengths. By understanding these components and characteristics of currency pairs, traders can better navigate the Forex market, anticipate movements, and manage their trades more effectively. Analyzing and trading currency pairs. Understanding the intricate dynamics of currency pairs is crucial for mastering Forex trading. Now, let's dive deep into the multifaceted approaches to analyze and execute trades effectively. We begin with fundamental analysis, which scrutinizes economic indicators, central bank policies, and political events to gauge their impact on currency values. For example, robust indicators like GDP growth and employment rates can significantly affect currency strength. A strong employment report from the US may bolster the USD as it reflects economic health, attracting investors seeking better returns. Likewise, decisions by central banks, such as interest rate increases by the Federal Reserve, generally strengthen the respective currency by offering higher returns on investments in that currency. Political stability or upheaval can also significantly influence investor confidence and consequently currency values. Elections or major policy changes can cause fluctuations that traders need to manage carefully. Transitioning to technical analysis, this method employs various tools to analyze market data and identify trends or patterns. Chart patterns such as head and shoulders or double top are crucial for predicting future market movements. Traders rely on technical indicators like moving averages to discern short-term trends from random fluctuations. The Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD, are essential for assessing market momentum. For instance, a moving average crossover may signal a potential entry or exit point, prompting traders to take action. Similarly, candlestick patterns like a doji indicate market indecision and potential trend reversals or continuations, while a bullish engulfing pattern suggests a likely upward movement. Sentiment analysis further complements fundamental and technical analyses by assessing the general mood or attitude of the market participants towards a currency pair. This approach involves examining sentiment indicators, market commentary, and volume and open interest figures, which can provide clues about future market movements. Traders must stay attuned to economic news and reports, as these can rapidly alter market sentiment. Positive developments may bolster a currency, while adverse news can lead to depreciation. Effective trading also necessitates rigorous risk management strategies. Setting stop loss and take profit points protects against sudden market reversals and locks in profits. The size of the position correlates directly with the level of acceptable risk and the distance to the stop loss order. This strategic positioning helps control the potential monetary loss per trade. Moreover, diversifying by trading different currency pairs or financial instruments can mitigate risks associated with any single currency's volatility. Finally, the execution of trades demands precision and timeliness. Trading during periods of high liquidity and volatility, such as when major market sessions overlap, can result in better execution and reduced spreads. However, the use of leverage, while potentially profitable, can amplify losses and should be managed cautiously. It is vital to continuously monitor open trades, especially in light of news or economic events that could impact market conditions. A proactive approach to managing and adjusting existing positions based on real-time market data is essential for responding effectively to market changes. By integrating these analytical and strategic elements, traders can develop a well-rounded and adaptable approach approach for navigating the Forex market. This comprehensive methodology not only supports informed decision-making, but also boosts the trader's capability to foresee and respond to market dynamics effectively. Leveraging technology in Forex trading. In today's trading environment, the use of advanced technology is not just an advantage, it's an essential component for success. Trading platforms like MetaTrader 4 and TradingView have completely transformed the way traders interact with the financial markets, making them indispensable tools in any trader's arsenal. On one side is MetaTrader 4. This one is a renowned platform known for its robustness and reliability, offering a range of capabilities from basic order execution to advanced automated trading strategies. This platform provides real-time access to market prices and liquidity, which is crucial for executing trades at optimal prices. It features a user-friendly interface that caters to both novice and experienced traders, supporting extensive chart analysis and the use of technical indicators. For example, traders can employ Fibonacci retracement levels to pinpoint potential reversal points or set custom alerts to keep track of significant market movements. On the other side, there is TradingView. This one is notable for its superior charting tools and unique social networking features. It allows traders to analyze trends, compare economic data, and share their trading ideas within a community, thus enhancing decision-making by tapping into crowdsourced strategies and feedback. Traders can follow top performers in the community to learn and possibly adapt their successful strategies for personal use. Moreover, the integration of mobile trading applications has made Forex trading more accessible than ever. Traders can now manage their positions, analyze markets, and execute trades directly from their smartphones or tablets, allowing them to respond quickly to market news and events, a critical ability in the fast-paced world of Forex trading. Additionally, the rise of algorithmic trading has enabled traders to automate their strategies. By programming trading robots, traders can set precise conditions for opening and closing trades, allowing them to operate on autopilot. This not only helps minimize the emotional stress associated with trading, but can also enhance the consistency of trading results. As traders continue to leverage these technological tools, it is vital that they fully understand the features and functionalities at their disposal. Continuous learning and adapting to new tools are crucial for maintaining a competitive edge in the dynamic Forex market. By embracing these technologies, traders can significantly improve their trading strategies and decision-making processes. Understanding Forex market mechanisms. As I said, the Forex market is an intricate global network of banks, brokers, and individual traders all interconnected in a system that operates 24 hours a day. This round-the-clock activity provides continuous opportunities for traders everywhere, making an understanding of the market's mechanisms essential for anyone involved in Forex trading. At its core, Forex trading is decentralized, which means it doesn't take place on a specific central exchange. Instead, the interbank market, which consists of large banks trading amongst themselves either directly or via electronic brokering platforms, forms the backbone of the Forex market. These major banks set the exchange rates through their transactions based on the dynamic interplay of currency supply and demand. Additional layers of liquidity are contributed by smaller banks, large multinational corporations, hedge funds, and individual retail traders. One of the key components in Forex trading is leverage. Leverage allows traders to control substantial positions with a relatively small amount of capital. For example, with a leverage ratio of 100:1, a market movement of just 1% against a trader's position could potentially exhaust their entire capital. Therefore, a deep understanding and careful management of leverage risks are imperative for all Forex traders to prevent substantial losses. Economic data also plays a crucial role in the Forex market, influencing the market sentiment profoundly. Key economic indicators such as inflation rates, employment figures, and GDP growth are monitored closely by traders. These data points can significantly affect the decisions of central banks regarding monetary policies. For instance, if the Eurozone reports higher than expected inflation, traders might expect the European Central Bank to increase interest rates, which typically strengthens the euro against other currencies. Market sentiment, driven by the overall attitude of investors toward a specific currency, is another critical factor. This sentiment can be influenced by a variety of elements, including political events, economic reports, and market speculation. Shifts in sentiment can lead to quick and significant price movements, requiring traders to remain vigilant and responsive to these changes. Furthermore, the high liquidity of the Forex market is a major draw for traders, enabling the execution of large trades without significantly affecting the market price. This feature is especially beneficial for scalpers and day traders who capitalize on quick, small gains throughout the trading day. By thoroughly understanding these market mechanisms, traders are better equipped to navigate the complexities of the Forex market, anticipate market movements, and manage their trades with greater efficacy. This foundational knowledge is vital for both new and experienced traders aiming to achieve success in the volatile world of Forex trading. Risk management in Forex trading. An integral part of successful Forex trading is risk management, which equips traders with strategies to manage potential losses and safeguard their investment capital. Understanding and implementing risk management strategies such as setting stop loss orders, calculating the appropriate trade size, and maintaining trading discipline are essential. Effective risk management recognizes that not all trades will be profitable. One of the most direct ways to control potential losses is by setting stop loss orders. A stop loss order is a directive to close a trade at a predetermined price level if the market moves against the trader's position. For instance, if a trader purchases EUR/USD at 1.1850, setting a stop loss at 1.1800 limits the potential loss to 50 pips. Another crucial element is calculating the correct trade size, often referred to as position sizing. This process involves deciding how much of the account balance to risk on a single trade. A widely accepted guideline is to risk no more than 2% of the total account on any trade. For example, with an account of $10,000, a trader should risk no more than $200 on a single trade. Understanding market volatility is also pivotal. Volatility affects both the potential for profit and the risk level. For example, currency pairs known for significant price fluctuations may require a wider stop loss to prevent premature trade exits. Traders need to tailor their strategies to accommodate varying levels of volatility, ensuring effective risk management. Lastly, psychological discipline plays a critical role in risk management. Traders often face emotional decisions that can lead to irrational actions, such as adjusting a stop loss order further away or pursuing more trades after a loss. Developing and adhering to a well-defined trading plan helps mitigate emotional decisions and enhances long-term trading consistency. By embracing these risk management techniques, traders can minimize their losses and position themselves to take advantage of profitable opportunities without endangering their entire investment. Types of Forex trading. In the diverse world of Forex trading, understanding the various trading styles is crucial for developing a strategy that aligns with one's goals, lifestyle, and risk tolerance. So we have to explore the primary types of Forex trading. Day trading, swing trading, position trading, and scalping. Each style has unique characteristics and requires different approaches. Let's start with day trading. Day traders take advantage of price movements within a single trading day, never leaving positions open overnight. This style is popular among traders looking to avoid the risk of significant price changes that can occur after hours. Day trading demands attention to detail, the ability to react quickly, and the discipline to adhere to predetermined exit strategies. It is well suited for individuals who can dedicate the entire trading day to monitoring the markets. Then it is swing trading. Swing traders hold positions positions for several days to capitalize on expected upward or downward market shifts. This type involves analyzing the markets on a deeper level, often using a combination of technical and fundamental analysis to make trading decisions. Swing trading is suitable for those who cannot trade full-time but can spend a few hours analyzing the market every night. There is also position trading. Position traders hold trades for weeks, months, or even years. They use a long-term approach, relying heavily on fundamental analysis combined with some technical methods to identify and follow major trends. This style requires patience and a good understanding of macroeconomic factors influencing currency values. Position trading is less affected by short-term market fluctuations and is suitable for traders looking for lower maintenance and potentially larger gains over time. And lastly, there is scalping. Scalpers aim to make numerous trades on minor price changes throughout the day. This trading style requires a significant amount of time and dedication, with traders needing to stay highly focused and make quick decisions. Scalping is well suited for individuals who desire fast-paced trading and can commit to continuously monitoring their trades. Each trading style has its advantages and challenges. Traders must consider their personal preferences, time availability, and risk tolerance when choosing their trading style. Developing a winning trading strategy. So as you can imagine, Forex trading demands a carefully crafted strategy that aligns with the trader's financial goals, risk tolerance, and understanding of the market. This section delves into how to craft a strategy that promotes consistent profitability. The first crucial step is identifying a trading style. Whether a trader opts for day trading, which involves completing trades within a single day, or swing trading, where trades may span several days to weeks, the chosen style will significantly shape their strategy. Each style comes with its own risk profile and necessitates a tailored approach to market dynamics. Next, selecting the right technical indicators is vital and should correspond with the trader's style. For instance, moving averages are ideal for trend traders who need to smooth out price actions and spot clear trends. Conversely, oscillators like the Relative Strength Index, RSI, or Stochastic are better suited for spotting potential reversals in markets that aren't trending. A robust strategy must also include explicit rules for entering and exiting trades. For example, a trader may decide to enter a buy position when a moving average crossover suggests an uptrend and exit when indicators signal a potential reversal. These rules should be rigorously tested against historical data to confirm their effectiveness, a process known as backtesting. Moreover, flexibility is essential in a trading strategy. The Forex market is notably dynamic, with conditions that can shift swiftly due to economic events or market news. Traders must be ready to adapt their strategies in response to these changes to stay relevant and profitable. Developing a successful trading strategy is an ongoing process of learning and adaptation. It is crucial for achieving and maintaining long-term success in the volatile Forex market. By continuously refining their approach, traders can effectively navigate market changes and enhance their trading proficiency. Advanced trading techniques and market analysis. Now, it is important to know that as traders gain proficiency, they often explore advanced trading techniques and deeper analytical methods to enhance their market capabilities. Scalping is one such advanced technique. It involves executing very short-term trades to take advantage of small price fluctuations. This method demands quick decision-making and an acute understanding of precise market entry and exit points. While scalping can yield high profits, it carries substantial risk due to the frequent use of higher leverage, which can amplify both gains and losses dramatically. Another sophisticated trading approach involves the use of derivatives, such as options and futures. These financial instruments enable traders to speculate on currency price movements without the need to physically hold the underlying currencies. For instance, Forex options provide traders the right, though not the obligation, to exchange currencies at a preset rate on a designated future date, offering a way to manage potential risks or speculate on future price movements. Further deepening their analytical capabilities, traders can utilize sentiment analysis to assess the mood of the market. Tools like the Commitment of Traders (COTE) reports offer a window into the actions of various market participants, enriching the trader's strategy with insights that go beyond standard technical and fundamental analysis. Additionally, an understanding of economic theories such as purchasing power parity, PPP, and interest rate parity plays a crucial role in forecasting long-term currency trends. These theories help traders grasp how fundamental economic differences between countries affect currency values over time, enabling more informed strategic trading decisions. By mastering these advanced techniques and deepening their market analysis, experienced traders can uncover new trading opportunities and further refine their strategies, leading to potentially enhanced outcomes in their trading activities. Practical examples of Forex trades. In this section, we delve into practical examples to demonstrate how the strategies discussed can be applied to real Forex trading. These examples will cover a variety of trading scenarios and will help you to have a view of different market conditions and appropriate strategies. First, consider a scenario with the EUR-USD pair, where the 50-day moving average crosses above the 100-day moving average, signaling a bullish trend. To take advantage of this trend, you would enter a long position. Before committing, you should verify the trend strength by checking additional indicators like the MACD or RSI for further buy signals. If these indicators confirm the trend, you would enter the trade slightly above a recent minor resistance level to maximize the potential of continuing the upward trend. For this setup, it's crucial to calculate your position size based on predefined risk management rules. Let's say you're allowed to risk 1% of your account per trade, and your stop loss position just below a recent swing low covers a 50 pip loss. This setup ensures that if the stop loss is triggered, you only lose 1% of your capital. Additionally, set a take profit point that offers at least a 2:1 reward to risk ratio, doubling the potential gain compared to the potential loss. Next, examine a short trade scenario with the USD JPY pair. Suppose there's a strong resistance level that the price has repeatedly tested but not surpassed. If the RSI indicates overbought conditions, suggesting a possible reversal, you might consider entering a short position as the price begins to decline from this resistance level. Here, you would place your stop loss just above the resistance level to limit losses if the price breaks through unexpectedly. In this example, consider any imminent economic announcements that could impact the USD or JPY, adjusting your trade plan to account for possible high volatility. This might mean setting a tighter stop loss or reducing your position size. Now, let's look at a breakout scenario involving the GBP-USD pair during a significant economic announcement, such as the release of GDP growth figures. If the GDP data exceeds expectations, the GBP is likely to strengthen sharply. In this case, watch for the price to break through a well-established resistance level on strong volume, which would serve as your cue to enter a long position. A buy stop order placed just above the resistance level will ensure you enter the market right as it breaks out, and your stop loss should be set just below the breakout point to guard against false breakouts. Our final example involves a complex scenario with the AUD-USD pair during geopolitical tension. Here, fundamental analysis becomes crucial. Suppose there's escalating conflict in the Asia-Pacific region. Such events can create significant market volatility. In this case, you'd integrate fundamental news with technical analysis. If the AUD shows signs of weakening due to investor fears, and technical indicators like moving averages and trend lines suggest a downward trend, a short position could be considered. In this trade, monitoring news closely allows you to manage the trade dynamically, adjusting your stop loss and take profit as new information emerges and market conditions evolve. This approach requires vigilance and a good grasp of both fundamental and technical analysis to navigate complex market scenarios effectively. Each of these examples shows how different strategies can be applied based on the market conditions and data at hand. By practicing these scenarios, you can develop the skills necessary to make informed decisions in your trading activities. Review and continuous improvement. To finish, we'll turn our attention to some of the most common pitfalls in Forex trading and how to avoid them. Understanding these mistakes can save you not only money, but also improve your overall trading strategy. Firstly, one of the most prevalent errors is the lack of a trading plan. Many beginners and even some experienced traders enter the market without a clear trading strategy or objectives. This often leads to impulsive decisions and inconsistent trading results. To avoid this, ensure that you have a detailed trading plan that includes your risk tolerance, profit goals, evaluation criteria, and trading methodologies. Stick to your plan rigorously and adjust only with careful consideration and analysis. Next is the issue of overtrading. Overtrading can occur in two forms: trading too frequently or trading with too much volume. This often stems from a trader's emotional response to both wins and losses. After a loss, traders may attempt to quickly recover their funds, which can lead to reckless trading decisions. Conversely, after a win, a trader might feel overconfident and take undue risks. To prevent overtrading, set strict trading limits and adhere to them regardless of your recent trading outcomes. Another common mistake is neglecting risk management. Even with a solid trading strategy, failing to manage your risks appropriately can lead to significant losses. Effective risk management involves setting appropriate stop loss and take profit orders to protect your investments. It also means managing the size of your positions according to your overall portfolio and not risking more than a small percentage of your capital on a single trade. Always remember, preserving capital is just as important as making profits. Misunderstanding leverage is another critical error many Forex traders make. Leverage can amplify your profits, but it can also magnify your losses. It's essential to understand how leverage works and to use it judiciously. Always calculate the total exposure of your trades and ensure it is within a manageable range based on your capital base. Remember, more leverage is not always better. Use leverage as a tool for enhancing your trading, not as a mechanism for gambling in the market. Lastly, let's talk about the psychological aspect of trading. Emotional trading often leads to poor decision making, whether it's the FOMO leading to jumping into unanalyzed trades or the inability to cut losses due to emotional attachment to a position. Emotions can be a trader's downfall. To combat this, strive for emotional neutrality. Develop a mindset where losses are seen as learning opportunities and not failures. Practicing discipline and keeping a trading journal can help you maintain an objective perspective on your trading activities. By addressing these common mistakes and implementing robust trading practices, you enhance your ability to achieve long-term success in the Forex market. Remember, successful trading is not just about making profits, but also about managing risks and maintaining an emotionally disciplined approach. And this is how you will be able to start trading Forex for beginners this 2024. However, if what you really want is to turn trading into your main source of income in this year and start earning anywhere from $1,000 to $1,500 per week, all this starting from zero with no knowledge or experience and dedicating only 2 to 3 hours a day. I have a proposal for you. Go to the link in the description of this video and click on it. There you'll find a website where I have a training that explains to you how you can do it in less than 10 minutes and how I can help you achieve these results in 3 months or less. Also, how to be the next student who sends me a screenshot of these results, which are the exact results that the Swing Trading Lab students are getting. Results of money that they are making on a daily basis, and you will be the next one. So click on the link in the description and watch the video fully. I'll see you inside.